Welcome back to Simple Mind Space, the podcast dedicated to helping you master your money and your mind. Today, we're diving into the exciting world of investing, specifically for teenagers. If you're young and eager to start building your financial future, you're in the right place. We're going to break down everything you need to know, from understanding the basics of stocks to navigating the world of custodial accounts, and even explore smart investment strategies tailored for young adults. Let's start with the fundamental question. What exactly are stocks? Think of stocks as little pieces of ownership in a company. When you buy a stock, you're essentially buying a tiny slice of that company. For instance, imagine a company has 1,000 shares available. If you buy 100 shares, you own 10% of that company. The more shares you own, the larger your ownership stake. Now, why do companies even bother with stocks? It's all about raising money. By selling stocks, companies can fund their operations, expand into new markets, or invest in research and development. Companies that offer stocks to the public are called publicly traded companies. Here's where it gets interesting for you as an investor. There are two primary ways to make money from stocks: dividends and capital appreciation. Dividends are like bonus payments that companies distribute to their stockholders. Think of it as a thank you for holding on to their stock. These payments are typically made quarterly or annually and are a portion of the company's profits. The amount you receive depends on the dividend yield, which is calculated by dividing the dividend payment by the stock price. Let's say a company's stock is priced at $20 and it pays an annual dividend of $1. That means the dividend yield is 5%. Imagine owning a significant number of shares in a company like Johnson & Johnson, known for its steady dividend payments. With a current dividend yield of around 2.74%, owning 2,212 shares, worth approximately $361,000, could generate around $10,000 in annual dividend income. That's passive income just for holding on to the stock. Next, we have capital appreciation, which is simply the increase in a stock's price over time. If you buy a stock at $10 and sell it later for $12, you've made a $2 profit per share. This profit is called capital gain. The forces of supply and demand heavily influence stock prices. If more people want to buy a stock than sell it, the price goes up. Now let's talk about a financial superpower that becomes your best friend when it comes to investing: compound interest. This is the snowball effect of earning interest on your initial investment plus all the accumulated interest from previous periods. In simpler terms, it's interest earned on interest. Imagine investing $100 today. In the first year, you earn a 5% return, growing your investment to $105. In the second year, you earn another 5%, but this time it's calculated on $105, not the original $100. This means you earn slightly more than $5 in the second year. While the difference might seem small initially, the magic of compound interest really shines over the long term. As years turn into decades, this snowball effect can significantly amplify your returns, turning small, consistent investments into a substantial nest egg. This brings us to a crucial aspect of investing: strategy. There are numerous investing strategies, each tailored to different financial goals and risk tolerances. Broadly speaking, they can be categorized into growth value investing and dividend passive investing. Growth value investing is more hands-on, with investors frequently buying and selling stocks, aiming to capitalize on short-term market fluctuations. This approach requires in-depth market knowledge, constant monitoring, and a higher risk appetite. On the other hand, dividend passive investing is a long-term game. Investors prioritize steady dividend income and gradual capital appreciation, often holding on to their investments for years or even decades. This approach aligns perfectly with the power of compound interest and tends to be less demanding in terms of time and market expertise. Before you dive headfirst into the world of investing, let's address some critical points. The most crucial aspect of investing is consistency. Regularly investing smaller amounts into well-established, reliable stocks is far more effective than sporadically investing large sums. This strategy, known as dollar cost averaging, helps mitigate risk by averaging out the purchase price over time, reducing the impact of market volatility. Remember, Time in the market is far more critical than trying to time the market. Attempting to predict market highs and lows is notoriously difficult, even for seasoned professionals. Instead, focus on starting early and staying invested for the long haul to harness the full potential of compound interest. Now, let's talk about custodial accounts, your gateway to investing as a minor. If you're under 18, you'll need your parent or guardian to open a custodial account on your behalf. These accounts function similarly to regular brokerage accounts, but are managed by the adult until you reach legal age, typically 18. Custodial accounts offer several benefits: 24/7 customer support, flexibility, simple setup, lower costs than traditional trust funds, and earnings are taxed at the minor's rate, generally lower. There are two main types of custodial accounts: UGMA, Uniform Gift to Minors Act, and UTMA, Uniform Transfer to Minors Act. UGMA accounts are designed for financial assets like stocks, bond mutual funds. UTMA accounts, on the other hand, can hold both financial assets and physical assets such as real estate, art, and jewelry. For most teenagers, a UGMA account will likely be the more suitable option. To emphasize the importance of starting early, consider this. Imagine two scenarios involving a Roth IRA, a retirement account with tax advantages. In scenario A, you start maxing out your Roth IRA contributions at age 18, assuming a 10% average annual return and investing in the S&P 500 index. By the time you retire, your account could potentially grow to an impressive $3.5 million. Now in scenario B, you begin doing the same, but just 1 year earlier, at age 17. This slight change in starting time could result in a retirement balance of $3.9 million. A difference of almost $500,000. This example powerfully illustrates the magic of compound interest and why starting your investing journey early can make a significant difference in your long-term financial well-being. Once you've grasped the basics, you can explore different investing approaches. If you're drawn to actively managing your investments, you'll need to dedicate considerable time and effort to research. This involves thoroughly analyzing companies, understanding their financial statements, evaluating their competitive landscape, and identifying potential risks and opportunities. Alternatively, you can opt for a more passive investing strategy, focusing on building a diversified portfolio of low-cost index funds, ETFs, and blue-chip stocks with a proven track record of growth and stability. Dollar-cost averaging is a particularly effective approach for this strategy, allowing you to consistently invest over time, regardless of market fluctuations. Whether you're a seasoned investor or just starting out, there are plenty of user-friendly platforms available to facilitate your investing journey. TD Ameritrade is known for its comprehensive offerings, 24/7 customer support, and vast investment selection. Vanguard is another excellent choice, particularly for those interested in low-cost index funds and ETFs. And if you're looking for a platform that simplifies investing with its intuitive pie chart-based system, M1 Finance is worth exploring, offering features like automatic rebalancing, fractional shares, and access to a wide range of investment options. As you embark on your investing journey, remember that knowledge is your most valuable asset. Continuously educate yourself about different investment strategies, market trends, and financial concepts. Don't be afraid to seek guidance from trusted financial advisors or mentors who can provide personalized advice tailored to your financial goals and risk tolerance. Investing is a lifelong learning process, and the more you understand, the better equipped you'll be to make informed decisions and navigate the complexities of the financial markets with confidence. And there you have it, a crash course on investing tailored specifically for teenagers. Now you're armed with the knowledge to take control of your financial future. Start small, stay consistent, and never underestimate the power of compound interest. Thanks for joining us on Simple Mind Space. Don't forget to subscribe and hit that notification bell so you never miss an episode. Until next time, keep those minds sharp and those wallets growing.